So I wanted to talk about some tax planning and saving opportunities there are for just everybody. Whether you are just strictly a W-2 employee or not, or own a business, there are some things that you can do to save on taxes. There are certainly more things you can do if you are a business owner or real estate investor, but we'll get to that in the next videos. I'm Joe DeSanto, by the way. I'm an independent CFO and business consultant. I actually spent most of my career in Los Angeles building a few multi-million-dollar businesses, and I've since semi-retired, and now I help other businesses and individuals manage their money and plan better for their future. So if you're interested in small business, personal finance, and real estate advice, please subscribe to the channel. Thanks. Okay, so one of the main things you can do is take advantage of your company's 401k if they have one. The 401k allows you to put quite a bit of money away, and you shouldn't look at the 401k as simply a way to save money for the future. You also should look at it as a way to reduce your tax liability today. So, what you save, what you make is not the end all be all, it's what you keep. So, by putting money in your 401k, you both save money for the future and you reduce the amount of taxes you pay today. So, it's really a win win. Now, if you happen to be a business owner, but in the sense that you're a consultant or independent contractor, you obviously don't have access to a company 401k, but you could create a solo 401k for yourself and be able to put even more money away. So certainly look at the solo 401k if you are an independent contractor. You could also look at the SEP as well. There's some differences between the two. Maybe I'll talk a little bit more about those in another video. The next thing is to buy a home. So you might not be a real estate investor per se, but you could be a homeowner, which I consider to be a real estate investment. And I think in essence, the government does as well. You could make the case. If you think back about the incentive concept I mentioned in the last video, the government offers you multiple tax breaks for owning a house. When you own a house and you have a loan on it, you pay interest on that loan. That loan interest is tax deductible. You also pay property tax on the house. That tax is tax deductible as well, up to a certain point. And then additionally, the second and even greater tax benefit to owning a home is if it's your primary residence and you've lived in the home for 2 of the last 5 years, when you sell it, you get $250,000 of free capital gains as a single person and up to $500,000 of free capital gains as a married couple. That is a humongous tax break for owning a home. And if you think about the incentives, it seems like the government wants to incentivize us to own homes. And I think owning homes is good for people, good for families. It's good for the neighborhood. You take pride in your property. You improve it. It's good all around. And the tax breaks are there to be had. Next one is get married. I know that some of these are a little personal, but there is potential tax breaks to be had if you are married versus single. Now, I will say this is kind of tricky in that if you are, say you're with a significant other now and you both work full time, you both have a certain, tax capacity, say, or tax bracket system that you're working into. If you get married and you both continue to work in the same jobs, your tax bill is not going to change all that much. However, if you get married and say decide to have children and one of you stays home with the children, now the one person that's working has the tax savings capacity of both people. So the tax brackets get doubled essentially. So instead of paying tax once you hit $20,000 as a single person, you pay tax when you hit $40,000 as a married couple. So you combine the capacity of the tax brackets, and that's how you can save money by getting married. Have children. I don't know if this fits into the incentive system or not, but governments and countries need new people. We need to replenish the population with young people, particularly when you consider Social Security and how new workers are paying Social Security benefits for old workers. We want to continually replenish the population. That gets, kids are expensive. It makes it hard to do. There is a tax credit for every child you have. Currently, it's $2,000. So if you have one child, when you go to do your taxes, you'll get a $2,000 tax credit, not a deduction, a credit. They reduce your tax bill by $2,000 for every child you have. So that may or may not be an incentive, tax incentive. I don't know. It might just be more about the government saying, hey, we understand that having kids is expensive, so we want to help participate and make it easier for you to replenish this population. Or maybe they're actually trying to attract you to have more kids. Who knows? Get a side hustle. So, a side hustle or a side gig, obviously that can bring you more income, which may be your primary objective. But most likely, or well, I shouldn't say most likely, if you can have the side hustle be in form of you being an independent contractor, you are now in business for yourself, and you are going to get afforded the same tax breaks that business owners get for that income that you make on the side hustle. Now, that might not, double your income or something like that, but you'll probably have access to enough deductions where that income you make on the side hustle could easily be tax free. I'll talk a little bit more about the deductions in the next video on how to use your business for a tax planning tool. But getting a side hustle both can give you more income and get you some tax deductions and make that more income potentially tax free. So it's a win win there. You can donate stuff that you have that you don't need anymore. Naturally, we give things away when we run out of room or we just don't need stuff. But if you take stuff to a qualifying donation place like Goodwill at the end of every year, you can get a tax deduction for that stuff. Now, I think there's a cap to this donation tax deduction. I think maybe it's $1,500. I know that it's been that in the past, but I would have to double check that. But nonetheless, when you go there, you just want to get a receipt and you're kind of on the honor system to say what I donated. If I were to sell it today as a used item, this is what I would get for it. That's the value that you can get as the tax deduction. So it's easy to do. You want to clean out your house anyway. Every year I usually go to the Goodwill at the end of the year, donate some stuff, ensure that you get the receipt from them, and you write down on the receipt what you deducted, and you create a value for that and give that to your tax preparer, or enter that into your tax, return system you're using. Maybe that's TurboTax or something like that. So go donate stuff. You obviously can also get charitable deductions from money that you give away. And if you're a higher income earner, maybe that fits into a tax planning concept that works for you. But giving stuff away, everybody can pretty much do. You can get an HSA or an FSA. So an HSA is a health savings account. An FSA is a flexible savings account. An FSA is usually something that your employer will offer you as a tax saving tool along with your 401k. An HSA is something you can get simply on your own, whether you get, outside of your employer. The way an HSA works is that you have to have a high deductible health insurance plan, and so you have to have a qualifying plan. But if you do, you can put money in the HSA and get the tax deduction for the amount you put in the HSA, and then you can use the HSA money to pay for out-of-pocket medical costs that you're probably maybe incurring more of because of that high deductible plan. So it's an easy way to turn your medical expenses into a tax deductible expense. Now, to expand on that, you possibly can get a standard without an HSA, a tax deduction for medical expenses if you have enough medical expenses. I believe they have to exceed 7.5% of your adjusted gross income, and then you'll get a deduction on the amount above that 7.5%. So if you happen to have a condition, or one of your family members has a condition that is causing a lot of out-of-pocket expense, you can get an additional health insurance deduction that way. I think you can combine the HSA and standard medical expenses, but you can't double dip. So, you would have the 7.5% above that minus the HSA you deducted, and then above that you could deduct. Next one would be if you are investing in the markets in taxable or non-taxable accounts, you can, at the end of the year, do what's called tax loss harvesting. I'll cover this a little bit more in the tax planning for investors, but this is essentially you sort of seeing what you own in your stocks, what maybe has lost money in that year. You could sell that. You could reinvest that money in some similar type of investment, not the same investment, because that would be a wash sale, and essentially capture some capital loss to then offset other gains and just, I guess, what would be the term? Sort of tweak the way your investments are getting taxed so they're getting taxed most efficiently. So that's another thing to consider about. The last one I'm going to mention in this video, it's a big thing, but it might be relevant to you, is you can move to one of the 7 states that don't have state income tax. I live in Florida. Currently, we have no state income tax here. I used to live in California. So come tax time, when I was in California, I did 2 returns, federal and state, and I paid my federal return and I paid money to the state. Here in Florida, I just do the federal return and I don't pay any state income taxes. So that is a humongous tax saver, no question about it. And the more you make, the more that tax savings will be. So certainly something to consider if you're thinking about a move, number one, or ultimately, a lot of people, when they do retire, they move to tax-free states for this very reason. Maybe you're getting close to retirement, you make that move earlier, who knows? Now that so many people can work remotely, moving to another state with no state income tax has become a viable way to possibly save on taxes. So there you go. There are some things to think about for everybody. I just want to close this in reminding you all, I'm not a licensed tax professional. I'm not a CPA. So anything I say really is just food for thought that you can talk about with your tax preparer and try to, help them help you, so to speak. Don't assume that your CPA or tax preparer will, dig out all the deductions available to you. Unfortunately, it doesn't work that way. You got to do some of your own homework and be your own advocate. So please do that. I'll see you in the next video. Bye.